Hello everyone, welcome to Success Wisdom. In this video, we're going to talk about the 5 things to avoid before retirement. If you are new to this channel, do like and subscribe to the channel. Let's face it, regardless of how much you like your career, we all desire a relaxing retirement. It's wonderful to be able to enjoy the rewards of your effort after decades of hard work. It's wonderful to be able to enjoy the rewards of your effort after decades of hard work. And the good news is that anybody can plan for an excellent retirement. It does, however, need meticulous preparation, which should begin while you are young. Not only does this increase the amount of time you have to save for your later years, but it also helps you better weather the financial risks that come with economic downturns, as many of us have recently experienced. Furthermore, beginning to save at a young age helps you better manage challenges like inflation and healthcare. Even with these considerations, there are errors that early retirees or any retiree may make that will have a significant influence on the quality of their post-career life. This is why it is important to be well informed not just when you begin your career but also throughout it. Early retirees must plan ahead and make realistic financial decisions. Yet, it is all too common for them to make the wrong financial decisions. According to the Federal Reserve, 36% of people who have not yet retired believe their finances are on track for retirement. Another 44% are certain they are on track, while the remaining 3% say they are not. This means that the futures of a lot of people are uncertain, and their problems will only get worse if they make these 5 mistakes when they retire. Building a retirement fund takes a lifetime, and unwise financial decisions might jeopardize your golden years. Fortunately, I'd like to help you avoid that issue in the future by sharing 5 things to avoid before retirement. Mistake number 1. Not establishing numerous revenue sources. Building a nest egg until it's ready to hatch and then breaking it to pay for your post-work years isn't enough for early retirement. Maintaining a good lifestyle in retirement will require having numerous streams of income rather than relying just on your investment alternatives or retirement savings. During your multiple resource planning, there are additional psychological advantages to depending on more than one source of income. However, you must factor in inflation, which is not included in your pension. Your Social Security payments are adjusted yearly to offset inflationary Medicare costs by investing in assets such as real estate and certain recession-proof equities, which you may collect early. If you make sure that the value of your money grows despite inflation, you'll get a greater payment of roughly 8% every year, which can't be claimed after the age of 62, and you can take money out of your 401k or IRA until you're 59 and a half. Otherwise, a 10% surcharge penalty will be applied to your earnings, further reducing your income and jeopardizing your retirement assets. An ideal early retirement plan should contain extra income streams that you can rely on before you reach the age of 59 and a half. Part-time jobs of savings accounts might be used as backup options. If you're an early retiree, bear in mind that withdrawals from assets like an IRA before the age of 59 and a half will result in income tax and penalties. Mistake number 2. Ignoring the expense of healthcare. While you're working, your company is likely to offer health insurance, and until you're totally retired at 65 or older, Medicare will be your primary source of coverage. When you retire early, you may be confused about your health insurance options since you are somewhere between working and truly retired. Unfortunately, the present state of health insurance uncertainty does not make matters any easier. For your early retirement, a financial planner or health insurance professionals will offer the best solutions and prices. If you have a spouse who is still working after you've retired, it's a good idea to join their health insurance policies. For the time being, the Cheap Care Act makes each state's healthcare exchange an affordable insurance alternative, and tax credits for reduced retirement income may include assets that may be used to offset costs. There is also direct primary care, which is a kind of alternative health insurance that charges a single monthly fee for any normal primary medical care services. I advise purchasing long-term health insurance before retiring early, since rates will rise as you become older. Also, if you are in your early retirement years and are still fit and active, don't overspend on health insurance premiums. The implications of aging will necessitate that your health insurance plans pay off as you become older, since you will need care and will not be able to depend on government policy to provide it. Even if you have supplementary insurance or Medicare, you will still have to pay for insurance deductibles, medical treatments that may or may not be covered, and insurance copay that may add up over time. Optical services are not covered by Medicare without incorporating long-term care services. The typical American couple's retirement health care will cost them about $285,000. With Medicare only paying 80% of your healthcare bills in retirement, you have two options: pay for extra coverage out of pocket or keep as healthy as possible. You'll be able to enjoy the remainder of your retirement in luxury if you set aside some additional income for such old age health bills. If you like this video, don't forget to like and subscribe to the channel. Mistake number 3. Social Security payouts are being mismanaged. Although it makes financial sense to delay collecting Social Security payments for as long as possible, you risk jeopardizing your ability to rely on your financial assets. Sure, deferring these payments until you're older may result in greater monthly benefits, but this isn't always the best option. If you're in a job that's not good for your health and you'll only be earning what you've worked for all these years, it's a valid reason to start collecting Social Security payments early. You'll be paid more money in the later decades of your life if you start collecting benefits soon after retirement. I waited much too long to apply for social assistance. This also implies that if you don't live to be 80, you're putting money on the table for the government. This is money that cannot be transferred. A lower monthly payment is preferable to no benefit at all. To summarize everything I've said thus far, first, you've reached the retirement age of 62 and want to put the money to good use while you're still working. Second, your overall income needs will necessitate withdrawing more than 5% of your current day's total from your retirement account, increasing the danger of premature account draining. Third, even though the money you get from Social Security each month is enough, you need more money. Mistake number 4. Not phasing into retirement. Don't make the error that many early retirees do by choosing a random age and then striving to save the amount required to accomplish their objective, since a black and white strategy never represents reality. Unless you gently phase down the procedure, your early retirement aspirations may become impossible. You may progressively downshift towards early retirement while still working from home, working part-time, or switching to a less demanding profession. By phasing out your career. A gradual transition towards early retirement will make it easier to bridge any psychological or financial gaps that may arise between your professional job and full-time retirement. Starting early retirement by your working less hours will shift your emphasis away from the end of your working career, enabling you to imagine your entire retirement sooner. A 45-year-old employee who wants to retire at 55 and earns $110,000 per year is an ideal illustration of a phased-out retirement. This individual's monthly benefits will be more considerable. They put off receiving Social Security for 5 years after being eligible. An early retiree with an above average wage history would get roughly $31,000 per year in retirement benefits using this technique. If the early retiree had completely stopped their employment at the age of 55, they would have been able to handle all of their costs until they were eligible for Social Security. The ideal course of action is to progressively decrease the workload by earning at least $50,000 in salary between the years of 55 and 59, with the retiree receiving $30,000 between the ages of 60 and 63, gradually lowering the amount of withdrawals from their personal retirement account. Mistake number 5. Not thinking about your legacy. Over 50% of elderly parents offer financial assistance to their adult offspring in some form. Early retirees, children are often younger and more dependent than average, making the financial strain onerous for them. After early retirement, if you have more than one kid to support, you may find yourself paying more than $1,000 per month, which is not unusual when considering your financial dependent offspring. Instead of cutting off your adult children, your early retirement plans will alleviate unanticipated bills and the relational pressures that come with them. Speaking with them before retirement will determine the level of financial assistance they should anticipate from you, ensuring that your financial goals are not jeopardized by new money demands. Establish ground rules with your children on how much and how long you will support them. Finally, you want to know that your financial future is secure when you retire. When it comes to preparing for early retirement, your sacrifices to save the retirement, your assets, and your Social Security retiree benefits all play important roles. Thank you for watching. I hope you have learned something from this video. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.